Hey, what's up, everybody? It is Memorial Day, Monday. Hope everybody's having a nice Memorial Day. It's a beautiful day here in New York City, really hot and sunny. I love it. So at least one day this weekend, we had a really, really nice day. I hope your Memorial Day is going well. If you're not celebrating Memorial Day, I hope your Monday's going well. All right, let's get right into it, folks. I did send out the new issue of MMT Trader. If you want to get a copy of that, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial. Remember, I'm the only one who has an applied approach to MMT. I take the concepts and understandings of MMT, and I use them to invest and trade in the financial market. So it's going to be a short week because of the holiday. We have Friday, we'll see the May jobs report. Should be pretty decent. They're looking at a payroll increase of 320,000. I don't see anything in either initial claims for unemployment or the average daily unemployment benefits. I track that. Actually, average daily unemployment benefit flows. That's the daily amount the government is paying out. It's down to a paltry 89 million bucks. I mean, it's like nothing, man. That is the lowest this fiscal year. So there's no sign in that number of any stress in the labor market or, a high level of layoffs or anything of that nature. So I think the number on Friday is going to be strong. And, as I've been saying, I think we're going to avoid a recession. And, the key thing for me, as I've been telling you guys, was the April tax drain, April 18th through May 13th. We saw about a $400 billion liquidity drain from taxes. And I was saying at the time, we have to wait until the government's budget balance for May flipped back into deficit. And when that happened, as soon as I saw that happen, I told you guys that is the bottom of the market. That is fiscal liquidity. That is real money. It's not the fake, phony monetary operations of the central bank, which is nothing more than a asset swap, either more reserves and less treasury securities or more treasury securities and less reserves. They're both the same thing. They're interchangeable. But government spending, deficit spending, adds to the financial balances of the economy. And, that's the swimming pool analogy that I've spoken about so many times. The pool is filling back up with water. There was a big crater in the bottom of that pool in mid-April until, almost the second week in May, actually the second week in May. And that got patched up, and now the water is filling back up. So it's all positive. Now, one thing we saw last week, and I think I mentioned this, was the market now starting to factor in or anticipate a pause in interest rate hikes by the Fed as of the September meeting. And it's kind of funny. Remember, I've been telling you that we're going to start to see a revision of the spin. The spin is the narrative, like what's going on, like everything is terrible. The market's crashing. We have inflation. We have a war. We have, monetary policy. The central bank raising interest rates. We're going to do quantitative tightening. All these horrible, terrible things that people were going freaking out about. And suddenly, bond yields start to come down all by themselves. We start to see some relief in some commodity markets, not oil, and I'll talk about that in a second, but definitely not in oil. And suddenly, the situation doesn't look quite as dire, at least from a yield interest rate perspective. And so what happens? The crowd, they have to reinvent the narrative. Because the market's going up, and in their minds it shouldn't be going up, and interest rates are coming down. That shouldn't be happening. Remember, we got the highest inflation in 40-something years, right? So they see that it's cognitive dissonance. They gotta rewrite the script as to what's happening. And now, I saw some comments like, the Fed went too far. Too far. You only had 2 interest rate hikes. You had a 25 and a 50 basis point hike, and now all of a sudden they're screaming it went too far. And it just shows you, like, it's almost like a clown show, the way they have to change, because they don't understand. You know, you get me? I mean, they don't understand what's going on. They don't understand from a really deep knowledge, almost like I could say a scientific point of view, a rational point of view, what's going on. Everything is hyperbole. Everything is like some made-up narrative, and it always is about the extreme. It's always about the extreme. When it's going up, it's about the extreme. When it's going down, it's about the extreme. But most of the time, if you look at the media, the way they craft it, it's in the negative. Because the negative, people get very excited. It grabs their attention. You know, it's like bad news sells. It gets people's attention, and you know, they need readers. They want people. But it's the same thing on Wall Street in the analytic community, because, as I've said so many times, it's this psychotic fixation on central banking and monetary policy at the exclusion of everything else. They don't consider anything else. This has been going on for 40 years, but it has intensified now to a degree that I can't remember it being so crazy as it is right now. I mean, everything you hear or read revolves around central banking and interest rates. Interest rates are either the panacea or the scourge of everything. And it's just a joke. It's just not reality. It's not the way things work. Their understandings are wrong. Monetary policy is, you know, these actions are just, as I've said, recomposition of the financial assets in the economy. We're talking about just different forms of a US dollar. If you're talking about the Fed, there is a price setting element to this when the Fed raises interest rates. And by the way, and I think I mentioned this, that was actually mentioned by the CBO, the Congressional Budget Office. That's the accounting unit of Congress, who said, you know, hey, you know, if the Fed's going to raise interest rates, we're going to have to pay more interest, right? That's a fiscal flow. That's a fiscal expansion. And it's going to, you know, it raises the inflation level. I mean, they said it. That's Congress's accounting unit that spoke about that. Anyway, let's talk about the market. We're back in an uptrend right now. Liquidity flows are positive for the rest of this fiscal year. This is classic seasonal stuff. We're going to get into the so-called summer rally. We had the, you know, sell in May and go away. It didn't last that long. It lasted about half the month of May. We got the liquidity, the fiscal liquidity flows are back. It's positive for the market. It's positive for risk assets. Let's talk a little bit about the dollar, and let's talk a little bit about oil. First of all, I'm going to talk about the dollar, and it appears now that the reassessment of the Fed's policy outlook, in other words, the fact that now the market is anticipating a pause in rate hikes in September, suddenly this has become bearish for the US dollar, and we're getting a correction in this. Actually, it was like 15-month rally. I mean, we basically went from January 2021 until about now. So 16-month rally in the US dollar. And now we're in a corrective phase based on, by the way, that rally, there was a couple of reasons for that. One was the anticipation of a hawkish stance by the Fed. The other was, and I think this is still an underlying bullish factor, although right now what's moving the dollar is the belief that the Fed is going to pause and interest rates might come down. Also, I mean, I've seen commentary now where they're saying in 2023 they're going to have to cut rates because of a recession. I don't see a recession. I said early on when oil prices started to go up because of the sanctions, I said we'd have to go well north of $150 a barrel for there to be a recession. By the way, today we're at 117 on WTI. But the dollar is in a corrective phase right now based on the, I guess, the view that the Fed may not have to take interest rates that high as previously believed. So we have that. But I said there's an underlying bullish factor for the dollar, and that is very, very strong petroleum, net exports of petroleum by the United States. The U.S. is a net exporter. By the way, if you want to know why you're paying such high gas prices, this is what happens when you export your bounty, your surplus. I mean, you send it off to the benefit of foreigners. And this is exactly what happens when you are a net exporter. It leaves less of a supply domestically, and that tends to cause prices to go up. And we're seeing that happen. I mean, U.S. now exports of petroleum, net exports. That means when you take exports minus imports, we're net exporting petroleum. And that is a very bullish situation. And I think that's one of the things that will continue to underpin the dollar. Although right now I could see that correction continuing for a while based on this kind of shift in the attitude that Fed monetary policy may not get as tight. There's the word tight. So let me talk about quantitative tightening. That's going to start, tomorrow? Not tomorrow's the 31st. It's going to start in 2 days. And that's a big remaining, worry for so many people, because for so many people, the belief of that is, hey, they're going to tighten. It has the word tightening in there. And so to them, it's a draining of liquidity when it is absolutely not going to have that effect. I've been over this before. To the extent that balance sheet reduction ends up reducing reserve assets at the banks. Remember, the banks right now, they got so much cash, so much deposits, they're actually shunting them off into the Fed's reverse repo facility. To the extent that balance sheet reduction results in a decline in reserve assets, that actually puts the bank in a better position in terms of their supplemental leverage ratio. All right? And it frees up space on their balance sheet to make loans. So credit growth, which is pretty strong right now. I mean, I went over the banking numbers from the most recent Fed release. Very strong. I mean, loans are rising at the fastest pace in 23 months. And that includes commercial and industrial loans. It includes real estate loans. It includes consumer loans. So very strong banking data. Once you start to get that QT going, and it's not a T at all, they can call it that and fine, because I'll let them do whatever they're going to do, short the market or get out or whatever, because that's not going to be the effect that will result from QT. I mean, it's actually going to be quite bullish for the bank stocks. It's going to, and that'll be bullish for the economy in general, because it's going to result in more loan creation, more bank credit. And, the economy can run on that for a while. It's not a perpetual thing like fiscal, but as I've said, debt service burdens historically are still very low. So, I mean, the cost to service the debt right now, it may be the debt nominal may be at a record, and it is, but the cost to service that debt is historically low right now. I think it's something like 9% of disposable income. That's way below what we saw in 2007 when it got up to something like almost 14% of disposable income. So that's it, folks. Everything looks pretty good. I'm bullish for this week, and you got to buy the dips, and that's it. All right, everybody. Have a great rest of the day, and see you tomorrow. Bye.